So the company that we picked today is Bull. So if you remember in the last session that we had on my channel, that is the Logical Investor, we basically said that having the skin in the game is an important aspect that we look for while we research in a company. But if you look at this company that we are talking about today, there is hardly any skin in the game. Promoter holding is around 2 to 2.5%. So Saurabh, why did you pick this company if it is so controversial, if it is so debatable?
Yeah, Shubham. And I think when we started analyzing together and we brainstormed this idea, the first question we discussed was this. And actually, what excited me was, it belongs to an industry where promoter usually don't hold very large stake. Here the promoter stake is very, very less. But what excited is Rakesh Jhunjhunwala, he holds a position in this bank. Ashish Dhawan, he holds a position in this bank. And in last 2 year, post-COVID, both of them, they have added to their position. So it looked like there is something worth, reading it here. So that was the reason.
But if you look at the chart of the company, right, the stock has actually fell 60% from the previous highs. Don't you think it doesn't be looking at this company?
So, it all depends how you look at the data. And I agree with you. But if I give you a reverse view, when we have seen in the Q3 FY22, when most of the companies have struggled to generate very good profit, in terms of year over year growth rate, this company has done a 5x higher profit year over year, and single quarter profit has been 185 crore rupees. So it may not be so bad. Something good is happening.
Look at it historically. Look at last 10 years of history. It has hardly generated any wealth. The CAGR return is minus 2%, which means it has really a wealth destroyer, right? So what gave you the confidence then?
So I agree with you, and the understanding of history is very, very important. But then, as they say, stock market valuation is all about the future. So now, if we look at the current business numbers, I think they are the best numbers in last 6 years. So what happened in last 6 years? I think we should not extrapolate that, but we should look at what has happened in last 6 years and why right now the numbers are best. And I think that is where the whole analysis lies. So with that, this is how the whole discussion started between Shubham and me. And when we looked at some of those numbers, we felt like, okay, let's go and explore further. So with that, we will tell you what excited us to research further.
If you look GNPA and net NPA numbers, look at how they are trending. So the GNPA, so obviously it's a banking stock. Now you must have known. But if you look at the GNPAs, the numbers were rising from 2016 to 2019. So the interesting thing here we found is that even after COVID, right, all the banks had like good numbers before COVID, and the NPAs shot up after COVID. In this case, it was the reverse. Numbers were rising, the NPAs were rising before COVID, and post COVID, they have actually been declining. So this is something really interesting, and they have come down 8.8% gross NPAs. They're now around 7%. Similarly, the net NPAs have come down from 5% to 2.6%.
And even though the GNPA number looks little higher, I would suggest look at the NNPA number. Why? Because in NNPA, basically it is post-provisioning. So GNPA might look higher, but it depends on how much of those NPAs have already been provisioned. And if you see this chart, you can see there is a ratio called PCR, which is called provisional coverage ratio. How much of the NPA have already been provisioned? And what the management has done, they have judiciously provisioned lot of these NPAs. And if you see this ratio itself, from almost 57-58%, this ratio is 79%. And let me tell you, a 70% plus provisioning coverage ratio is considered decent. So you can see that they have done a very good provisioning, almost 79-80%. And that is why the NNPA number, which you look, it doesn't look so bad. Like many good banks are having around 2% NNPA number, so 2.5%.
So don't want to keep it a lot mathematical. So let me quickly explain both in like slight detail. So NPA is simple like non-performing asset, which means if you look at the banking model, right, if you give a loan and the loan that is not coming back to you in simple terms, and net NPA, that is gross NPA, and net NPA is essentially when you say, okay, I expect this to come back, and then you account it in your profit and loss statement, right? And that is the net NPA. So whatever is left over is the net NPA. And if you look at the net NPA divided by gross NPA, that gives you the basically the difference of gross NPA and net NPA divided by gross NPA. It gives you basically how much already accounted for in your profit and loss. That gives you the provision coverage ratio. So yeah, just wanted to quickly point this out before we move ahead.
Yeah, thanks, Shubham. Thanks for highlighting. One more thing which excites us is if you look at something called RWA by total asset, where RW is basically risk-weighted asset. So no, there are different kinds of lending which happens, and every kind of lending, whether it is gold lending or housing lending or LAP lending or commercial loan, every lending, there are different kinds of risks which are assigned to it based on the history. And risk-weighted asset basically tells, to total asset, it tells you how risky are the assets where the lending is happening. And again, if you look at this trend, from 66% in 2018, it has gone down to 52% in 2022, which is again a good sign. And we'll discuss in later how it is happening, why it is happening. So that is one more data which excited us to deep dive further.
Another exciting number that we found was, so if you look at just 1 year, right? The net profit of the company in December 2020 was 35 crore, which has now increased to 460 crores. So if you look at the percentage term, it is really huge. It is obvious also, right? Because the COVID effect is slowly subsiding. The banks are coming back to like pre-COVID levels where they were. So if you like compared to other banks, this bank has done like really well in that terms. And this is the most exciting slide. Any bank, if you look at it, right, is currently most of the banks are available at like 2 times, 3 times book. This bank is available at 0.6 times book, right? And obviously, when you see 0.6 times books, this is what comes to your mind. That is it a PSU? PSU hai kya? But no, it is not PSU. It is a private bank. So private bank currently available at 0.6 times books, historically low valuation. So this is the reason what excited us the most.
So now let us, get to analyzing the company, and maybe some of you would have guessed by now which bank this is. But whenever it comes to, analyzing the bank, it is very important to study something called 7 deadly sins of banking. And this comes from a very popular book called Capital Returns. We will, request you to read this book. And I think whenever you analyze any bank, you should take care of these 7 parameters. So we will analyze these 7 factors, and in those factors, we will try to analyze what good or bad this particular company did, and then how it is shaping up. So if we look at the first 2 sins, they are imprudent asset liability management, or ALM, on the balance sheet, and then supporting ALM mismatches by clients. So to give an example, if we look at the ALM mismatches, those of you who are there in the market from last 3-4 years, you would have heard about the ILFS crisis, the FBFC crisis, the housing finance company crisis. So basically what they try to do, banking is a business where you collect money and you lend money. And your collection of money is your liability, because you are responsible for giving it back to your customers who are putting FD or something. And your asset is the loan book which you have given, because you can recover. So on one side you collect, other side you give. So if you are collecting on a 1-year basis and giving loan on a 5-year basis, that can create time-based mismatches. So how much you are collecting and how much you are lending, it has to be proportional in a time bucket. And whenever there is a mismatch, that can lead to issues. And why companies do that, or why banks or financial institutes do that? Because while collecting, they might be putting, giving lesser return on a short-term basis. So they might be interested in doing things which might look good from short-term in terms of creating a higher spread, which is the difference between lending rate and, the deposit rate. So many times they try to do this and find themselves in trouble, or NBFCs. And that is what happened in 2018. So this is one of the areas where we should be very, very cautious when we are discussing a bank. And if we don't talk about this company, that means they have done okay on these parameters, but where they have gone wrong in these 7 sins, it will come in next few slides. So Shubham, do you want to discuss the third sin?
The next reason is basically lending to someone that can't pay, that won't pay, right? And here comes like if you look at the top quality banks that are like in terms of like how people perceive, right? HDFC, Kotak, ICICI. So think of it that they basically cater to the cream of the entire thing, right? The class, the higher paying people, and they're the least risky ones.
Whole recession, which everybody remembers, 2008, that was nothing but a subprime lending. That is the best example of, you can't lend to somebody who's not going to pay you back.
Exactly. And it's not like lending to people who are, obviously, if you are paying to people who can't pay back at all, that is the biggest sin. Even like you can still make money while lending to people who earn a little less, but have the capability to pay if you basically have higher spread, right? And that's where banking becomes a little complicated. There are so many things that you have to look at. Like you can't be like looking at one ratios. You have to look everything collectively, right? And that's where you find you. And so yeah, the next sin that comes to mind is that how good are the people that you are lending to. And in this particular case, they are basically lending to so we'll talk about it in detail, but they have 4 types of loans that they give out. They give out agri loans, they give out corporate loans, they give out commercial loans, and basically they also give out the personal loans, the vehicle loans, the home loans, those kind of things. So we'll basically talk about it in detail.
Yeah, and this is where the fourth sin comes, which is getting into unfamiliar areas. And as Shubham told, there are the 4 segments where this company lands. And something they did between 2012, 13, 10, which is haunting them. And they got into some of the unfamiliar areas. So management, to drive much higher growth, they took a strategic call of getting into corporate lending and all. And actually, if you see this chart between 2009 to 13, there was a loan growth rate of almost 30% CAGR. So in business, especially in banking, don't get excited about the P&L growth, because what you are growing today is going to haunt you after 2-3 years in terms of NPS. And that is what happened. From 2013, the growth rate all looked rosy, but only when came 2016, 2017, the NPS started getting highlighted. And, that is why the bank has lost, lot of shareholder return. It's 60% down, and the 10-year return is like almost negligible. So it is very, very important that when they are getting into unfamiliar areas, they have to be very prudent in terms of lending, because lending is easy, collection is difficult. So then comes the 5th and 6th sin, which is related to off-balance sheet lending and getting sucked in vicious cycle dynamics. So basically, this belongs to, when you are lending or in any business, if you are keeping a lot of things off balance sheet, which means you are not putting them in your balance sheet so that you can reap the advantages and you can show the balance sheet in a better manner. And it is not only prevalent in banking, even in other sectors. Like the whole Enron case, everybody knows the biggest fraud, which is Enron. Enron was a case of, off balance sheet item where they tried to, make the balance sheet look really good, but it was not. So these are again some of the sins which one should be, really cognizant of. And of course, relying on a rear view mirror, because a rear view mirror only tells you about past. And in banking, I'll tell you, it's always about what will happen in next 3 years. The last 3 years can look very rosy, but those rosy picture is nothing but it's a preparation of the bad time to come. And last 3 years could look very bad, but there might be signs of good time to come. So that is how a banking works. And in banking, you should not consider, on a year-to-year basis, but you should always think in terms of what it can lead to in next 3-4 years. So these were the 7 sins, but based on our personal, experience on banking, and especially I have lost money in some of the banks, let me admit it. I added 3 more sins, which I feel it's a sin and we should be cognizant of. Is one, achieving more than what one can. So if, in banking, the growth is easy. If you want to go, कहते हैं ना, चादर से ज़्यादा पैर नहीं पसारना चाहिए. So there are banks who do that, and whenever they do that in an imprudent manner, they suffer. Also, the peril of concentration, because if you are lending high to certain accounts, and if those accounts backfire, you are in the game of leverage. So your chances of damage is like multiple times. Like in FNO, they say, no, it's a leverage game. In cash, if you lose 1 rupee, in FNO, you'll lose 5 rupee, you'll gain 5 rupee. So those risks are there in banks. And one bank where I faced, such issues is, RBL Bank, where, only 4 accounts went bad, but those 4 accounts were almost 1800 crore of NPA, and it's a small bank. So for them, those 4 accounts mattered much because they destroyed a significant amount of net worth. The other thing was, already banking is a leverage business. So if you try to play the game of multiple levels of leverage, it can be destructive. And how it has happened is, so it's always already a leverage business. And then some of the executives, they took loan against shares of that bank. And when the whole business went bad, first the leverage backfired, and then their loans, the shares which they had taken, those shares got sold in the market at, throwaway prices or whatever not. So no, the game of leverage is very, very risky. So these are some of the additional things we should be very, cautious when we are dealing with any kind of leverage business, whether it's, banking or whether it's NBFC or something. So with that keeping in mind, now let us try to understand the journey of KVB, what is happening and why, the detailing of some of the exciting numbers which we showed. So Shubham, do you want to take it further?
So, sure. I think you haven't even told which stock is it. So let me make it, let me disclose it. So this is actually Karur Vyasya Bank that we are talking about. 100-year-old bank, more than 100-year-old bank with a legacy, with a mostly concentrated in the south, more than 7 branches. Majority of their loans and asset book and the liability basically comes from south, has some few branches in the north, but not to a large extent. So I think you covered so many things, but then still, right, if a person wants to invest in a bank, right, so what are the things that he has to look for? So what you covered is, okay, a bank should not do this, but then essentially there has to be something concrete that he can look at to basically get a grasp on, okay, what we are talking about, right? And I'll talk about some of the metrics, and then we'll discuss those metrics for this bank. The first thing is, bank model, as Saurabh already explained, is very simple, right? You lend money from someone, which is the CASA, right, or the deposits, which is the current account. You don't pay anything for current account. For saving account, you pay a minimal, like 2% kind of a fee, and then deposits you have like 4 or 5%. So yeah, you want as possible give out the money as basically as much as basically the percentage terms, you want to earn as much yield as possible. Then the difference is the net interest margin. So in any banking, you look at like few metrics I'll talk about. One is the NIMS, which is the net interest margin, which is the difference between that and what you get the money at. So what is the trend for NIM? Then you look at how is the CASA ratio forming, which means if there are more current accounts, you can lend money very cheaply. The next metric that we should be looking at is the concentration, which I think Saurabh already covered. Really, really important. So like in RBL, if you are only giving money to very few concentrated customers, right? If one of them goes bad, you have a very high risk of your bank bad, right? The entire bank might go bad. So yeah, if the concentration is not there in terms of sectors, there is not a lot of patient. Then to get the overall picture, the ROA, ROE gives you a very, very clear picture, which basically tells you return on asset simply means that asset, in case of, if you look at any factory, right? For a factory, the asset is the plant, the whatever the machinery, right? Bank, the asset is the money that they have collected, the money that they have lent to people, because they will slowly get it back over a period of time. So that is so whatever money they have lent, their loan book is the asset, and whatever return they are earning is the return on asset in simple terms. And here if you look at most of the banks, they only have 10% of their money which belongs to them. 90% of the money doesn't belong to them, they lent out, right? Which means if there is a 10% NPA, which means 10% of the loans that you give go bad, your entire money that you have can go bad. So that is the basic model of a bank, right? So keeping the management becomes very, very important. So now let's deep dive and try to discuss these. You want to add anything, Saurabh?
Yeah, Shubham, I'll just try to summarize what you said. Very relevant point. And Shubham spoke about some of the key metrics. So if you look again from a P&L balance sheet and all perspective, what all Shubham discussed is, One, you need to manage your liability side where your deposits and your CASA, granularity, those kind of metric come. Then you need to manage your asset side, which is the lending part, how much you have lent. That is where your NPAs and provisioning coverage ratio come. Third is your operation side, how efficiently you are running this whole operation of collecting money and giving money, which you see in your P&L, your expense item, your employee salary. That is what your cost to income ratio comes. And fourth is the most important part, which the Shubham spoke about, the ROA and ROE, where you bring your liability, you bring your advances. Now, by managing this liability and advances, what is the kind of return you are generating? And that becomes your ROA, ROE. And whenever you have to compare, two or two more banks, these are the golden metric on which you compare, because it covers everything. And then it tells about the efficiently, how efficiently and how more profitable the bank is being run. So keeping that as a crux, let us see how Karur Vysya Bank has done in last few years, and what good things they are doing, so that we got excited to just study it in detail.
So let's now talk about the FY14 period. So if you look at the ROEs number, right, they were declining till FY15. There was a slight jump in 16 and 17, and then it started declining again, right? And then COVID hit. So the reason we see this kind of a graph is because what happened is that the focus changed in FY12, focusing more on corporate lending, which is like big ticket size loans, which is like more than 100 crore kind of a loan. These are companies, these are not like very big companies. If you look at in terms of banks, they give loans to relatively like smaller companies, but like, as I said, for them, even 100 crore loan is a big ticket loan. Actually, we all know what happened post that, like GST and all came, and then basically even the MSME sector was the one that got hit after that. And the ROE number kept on declining, and the NPA shot up. So basically what happened was, in short, the banking had like very bad kind of NPAs numbers, and now basically in FY 2021 we all know COVID, and after that, right? And even there, this basically they were hit really badly, because the focus was on SME, and even COVID impact.
And to add to Shubham, if you see this chart, if you see FY19, from FY19, this is the expected number. So basically, we have taken this chart from a report from Nirmal Bang, which came in 2018. And of course, they were already in corrective measure. And based on that, Nirmal Bang, they projected that by 21, the ROE will shoot up to 14%. But it has not happened. Mm-hmm. It has improved. Still, I think it's near 10%. But then they didn't factor COVID. Nobody factored COVID. And because of COVID, it couldn't become as good as where it is, but of course it is much better than the 6.1 number.
So if you look at what they are doing to improve, basically, if you look at the first chart, which is the NPA, so one thing is they are clearly improving. The NPAs are coming down, both the gross and the net NPAs are coming down. This chart shows you the provision coverage ratio. So as we already talked about, almost 79% of their loans which went bad are already covered, which is really good. And the reason, basically what they are doing is they are basically saying that, okay, now we'll slowly change they're focusing on retail more, and they're slowly diversifying away from the corporate lending. So if you look at this table, right, this chart basically shows you how the corporate lending has gone down from 35 to 22%, which is where they got hit the most. And their focus on retail lending, even in the retail segment, basically their focus has been on the jewelry segment, which, if you see, jewel segment has grown from 18% to 22%. Even if you look at the retail segment has grown from 15 to 23%. So essentially, clearly what it shows is slowly diversifying from the corporate side of things and slowly going into the retail side of things, more safer assets. Even in the retail segment, they are mostly covering the home loan. So if you book, 50% is now in home loans, which 52%. The more riskier kind of things like LAP are around 16%. So essentially, that's what this looks encouraging.
Actually, they do a lot of disclosure. So if you'll go through the investor presentation, there is a lot of disclosure. Some of them might highlight the risk also, but good part is they're transparent. And even if you see the housing loan, they give a breakup of, how many percentage of people were given loan in the 750 plus credit rating, 700 to 750. So of course, it will not look like very pristine where everybody is having a rating of 750, but you get the distribution. Also, some of, the loan category is, self-employed and all. So we should take cognizance of those risks, but I would suggest go through the investor presentation to get into detailing to understand the, all the aspect, both from opportunity and risk side. So the third good thing which I saw was, of course, when you have to do something very different from what you have done in the past, it all starts from the management. And that is where I saw there has been a change in the top leadership, right? From the whole MD CEO to even the other senior executives. And a lot of new senior executive hiring has happened in last 3 years from 2018-19. And if you see the people, they have come from reputed institutes like Kotak Mahindra Bank or Axis Bank. The current CEO is from SBI, and he has lots and lots of experience the running the bank cluster, especially in the south side. So looks like they have done a lot of senior level hiring in last 2-3 years to drive all of this. Fourth, again, you will think that this is not a USP, but again, why I'm highlighting, because the image, and actually this bank didn't do anything great. So when you are not doing anything great, doing the basic itself is a good step, especially when your valuation is like as good as a PSU valuation. So there has been a lot of focus on the digital banking side, neo banking side. And if you look at the numbers, you will see there is a push and there is an increase, whether it is about the transaction or whether it is about the installation of the app, or whether it is about the lending which is happening through the digital channel, or whether it is about all the banking initiatives which is happening through the neo banking side. So there are a lot of interesting things which are happening on the digital and neo side, which is again a good step. They are also exploring new revenue sources. So as I said, in fact, I spoke to a friend who is from Chennai, and I told the South Indian bank, his first thing was, these banks, they don't grow. They don't want to grow. So, that is the mindset. But what I see is, at least they're showing that mindset that, okay, they want to grow. So what are the growth areas where they were not there? They never did cards kind of business, credit card. So in 2019, they started getting into card. First, they tried with, card for commercial clients. Then quickly, I mean, within a matter of few months, they rolled something for consumer side also. So the kind of businesses which they have not gotten into, and these are high growth business, they have shown the intent to get in there. The third party based non-interest revenue sources, whether it is selling the life insurance policy, health insurance policies, they have started doing the tie-ups. They have started, getting into ecosystem, whether it's API based technology tie-up or these kind of non-interest things. So there is a lot of intent to do things which they have not done, which could again add to the growth. So that is another interesting things. So we spoke a lot about the asset side, the prudent lending or NPA or P&L side. But Shubham, do you want to talk about the sixth point where how they are managing the liability side?
So before, just want to talk about one thing, and that is everything comes at some value, right? I think what makes it exciting, I want to repeat, is that because it is trading at like hardly anything, right? It's trading at 0.6 times book. And even though if you look at, there are so many things which are not as the leading private banks, I think valuations, like the starting valuation plays a very important role. And when like nobody's late and they are showing signs of improvement. So yeah, let's talk about the management that they have done. So very simple, right? Look at the CASA ratio has been increasing continuously for last 5-6 years, from 23% in 2016, 36% now. Look at the concentration of the top 20 depositors, which is this is the liability side basically, which means people who are giving, who are doing FDs, who are doing saving accounts, are like any other bank, right? Are very small. So there are like thousands and lakhs of customers, and top 20 depositor constitute only 6%, which means that it won't make a lot of difference to them. There is very less concentration. Even if they lose, it shouldn't be a problem.
Of the banks like HDFC and Kotak, they work around 45 to 50% CASA. The worst of the banks who start, they work around 20 to 30% CASA. So I would say it's somewhere, higher than the mean.
In the middle.
Maybe if they increase 4-5%, they get into that 40% tier. Because some of even the bigger banks, they have 40 to 43% CASA. So I think they're good. If they can improve 5-6% more, nothing better than that.
So basically this kind of a CASA helps them get around like 4.5% kind of a cost, which is a decent number if you look at it, not compared to so yeah, obviously if some other bank is doing 55-60% CASA like an HDFC, obviously not as good as them, but still a decent kind of a number if you look at the industry per se. Let's dive the ROE and ROA numbers. As we said that this is the most important metric. At least I feel this is the most important metric that I track, because this basically tells what is the valuation that you are going to get. If you are doing an ROA above 2%, obviously you'll get a very, very good valuation. Above 1% also, you can at least, I feel personally, you can at least expect one-time book. And they're slowly inching towards that. So if you look at this graph, right, they guided more than in FY24. And if you look at it, in 2016, their ROAs were 1.03%, came down to 0.3% in 2019, 0.32 in 2020, slowly inching back up. If FY22 already at 0.93%, though there's still 0.6 time books, which I think is the opportunity, is what I see. If you compare it with other banks, right? Kotak Banks has a 2% ROIC, has 1.9, ICICI has 1.2, DCB and a Federal have 1.1, 0.9. You can see in this chart. So essentially of where this lies. So it is kind of a below average, below most of these banks, but similarly in terms of valuation.
And just to add to Shubham, so first, these numbers are mean taken for last 7 years pre-COVID. So that gives you a fair idea. So that if you want to benchmark what is a good ROA, above 1% is decent. Anything more than 1.5%, very respectable. Only your top banks have. Same way ROE, 12% is decent. Anything above that is, very, very good.
Let's now see what can go wrong. What are some of the key risks that you see in the story?
And the first thing itself, you saw in the sin, one of the 7 sins, reaching to growth in unfamiliar areas. And this is something which they are doing, and we need to, look at it, because the growth is the easy part. Sustainable growth is the difficult part. Lending is easy. Collection is tough. And if you see, the company, they have gotten into some new areas like credit card and all. They don't have a lot of experience. So I think these are the things which we need to watch and monitor. And that is why watching the NPA numbers, monitoring the ROE becomes very important. Many times people say, what is this bank which will do well? I think any business, and especially in banking, it needs to be monitored on a constant basis to see if, it is deteriorating or improving. Because whatever they are doing today, the repercussions of that will come after 2-3 years. And if they have done in the good manner, it will be sustaining one. If you do in the bad manner, it will lead to NPAs. So those are the risks which we must factor and be cautious of. Third, if the bank had a decent history of CEOs staying for long, but the previous CEO who came before current CEO from Citibank, he didn't last long. So, I mean, let's hope the current CEO, he continues for a longer duration, but we need to monitor that. Then there is another important part, which is post-COVID, a lot of, stressed asset and restructuring has happened. And we are providing you a paragraph from one of the credit rating report. And when you see that, even though currently the NPA numbers are looking okay, there is a significant bucket which is still need to be monitored for next 2-3 years, how it performs and what percentage of that will convert into NPA. So even your NPA is declining, this is one factor which we need to monitor, and this will decide whether the NPA stays here, goes further down, or again deteriorates from here. So these are things which we need to really monitor. And there are certain current high growth areas where the bank is growing, like a housing loan and all. And these are little longer tenure loans. Sometimes, you will not know the quality of these loans in immediate future. Only after 2-3 years you will come to know. So again, we need to monitor, and sub-segment wise how each of these loans are doing in terms of NPA, we need to monitor it. As Shubham had said in the beginning, this is typically a South Indian bank, which is predominantly present in South India. Tamil Nadu is a bigger part, so there is a geographical concentration. If anything bad happens in a specific geography, then it will impact the bank. So we need to monitor it. 7, the overall image itself. There are certain companies which get that Thakela kind of image. And many times it is very difficult to change. Market takes 2, 3, 4 years to realize the image has changed, even if it has changed. So one, it looks like it is changing, but the change needs to sustain. And then market needs to perceive that, okay, the image has changed, which could be a long process. So it may not sometimes get into share price appreciation immediately, even if they continue to do the good thing. The last and most important thing is the credit cycle revival. And I think I have been tweeting from last 2-3 months that I'm bullish on banks. And the reason I will tell you is, you look at the bank credit cycle chart, which is very, very interesting. If you look from 2005 to 2021, right now we are at almost the lowest end of bank credit cycle, which bottomed in 2017 at 5%. And then it went up, but again, COVID hit and it is again at the same 5%. But the decline of this looks like it has stopped, and maybe this is where we will find the bottom. So when your whole industry credit cycle of lending itself has formed the bottom, only improvement can happen. And this has not happened for the first time. If I show you the data, which is 25-year-old data, the same thing happened in 2002 also, where from 2000 peak of 11%, we bottomed at 5%, and then we went through the huge credit cycle. And that is why 2003 to 7, you saw a very good improvement. So the question is, if now the credit cycle will revive, how it will revive? And it can revive either two ways, either the industry loans or the retail loans. If we look at the industry loan, it doesn't look that rosy, at least as of now, because if we look at the 2-3 year capex plan taken from one of the Kotak report, it doesn't show anything exciting, but the retail side looks like it will grow, and it has grown at 15%, and looks like it will continue to grow. And housing and card, they are some of the good businesses where the growth will come. And that is where, this bank also, I think they have done reasonably well in terms of housing loans so far. I hope the collections will continue to be good, and card is some area where they have entered, and they expect to take it further. So this is where we see the credit cycle. But if it doesn't happen, let's say this 5% doesn't reverse, or maybe it takes next 2 years to reverse, so then the whole story of growth can also derail by 2 years. So we are depending on the industry cycle to play out.
Right. So I think in short, this could be a bet on the revival of the industry cycle. In short, we know that obviously, if you want to play a game where which is not getting, which is cheap, which is a private bank, where people, there are big players involved, and you think that change happen, then this could be one place. So I think what am I doing? I generally try to stay away from on banks. I stay with bank index, which is bank B's. I usually do it via ETF, which is which on the banking cycle and not really on any particular bank. But I think if you want to play the bank, if there is bank revival, there is a capex cycle revival, there is a retail revival that might happen over the next few years, this could be a good play to play.
Yeah, Shubham, I also try to play through a mix of bank ETFs, some the proven kind of banks, and then a small portion of these kind of banks where at least the risk reward is high if things go well as per plan.
Yeah, just to conclude, banks, I think you basically need to diversify your risk is the conclusion that time. Bank is as is highly leveraged, and the risk is on the higher side, and so essentially diversifying and not putting a lot of money in a single bank, or if you are putting it, be a little on the safer side. Is what I would
like to conclude based on experience. Banking, it's a cyclic game. In this industry, cyclic. Get in and exit when the lending is at the peak and good times are on. That is the time we should exit, because all the lending which happens in one cycle, the recovery is visible in another cycle. So that is how we should play.
That makes sense. Totally. Cool.
Okay. So this was the stock for today's discussion, and thanks a lot, Shubham, for helping on this analysis. It has been fun analyzing these companies together, and we will continue to do it. And again, we will make next video in next few weeks. And again, that video will come in Shubham's YouTube channel, which is The Logical Investor. So keep following both of our channel, and we will keep doing it, alternatively on each other's channel. Thanks. Thank you for your time.